It's 2:17 a.m. Pakistan Standard Time, February 27th, 2026, and while you were sleeping just 43 minutes ago, the Asian markets opened their Thursday session, and something absolutely terrifying just happened. Singapore, Hong Kong, Tokyo, Shanghai, all four institutional trading desks simultaneously executed the same trade. They're panic buying crude oil, not gradually, not strategically, but like they know something catastrophic hits in exactly 11 hours. This isn't normal overnight volatility. This is front-running a geopolitical nuclear event. And by the time your morning alarm goes off, the price will have already gapped beyond your entry point. Unless you understand what I'm about to show you in the next 8 minutes, listen, if you've been watching us for a while and you appreciate that we don't sugarcoat the economic reality, do me a favor, hit that subscribe button like you're locking in a trade before the market gaps up. You know how back in your day, people would call their broker at 6 a.m. to get ahead of the morning bell? That subscribe button is your 6 a.m. call now. And drop a comment below. Tell me where you're watching this from. Lahore, Karachi, Dubai, London, New York. Because what I'm about to reveal affects every single time zone differently. And I need to know who's actually paying attention right now. It is 11:47 p.m. Eastern Standard Time on February 26th, 2026. Most Americans are asleep. Wall Street closed its doors 4 hours ago. The trading floors in New York are empty. The Bloomberg terminals have gone dark. CNBC stopped broadcasting. Portfolio apps have frozen at their 4 p.m. closing prices. But halfway around the world, something is happening. In Singapore, it is 12:47 p.m. on Thursday, February 27th. The trading desks are fully staffed. In Hong Kong, it is the same time. Tokyo is 1 hour ahead at 1:47 p.m. Shanghai matches Hong Kong's clock. These four financial centers have just opened their Thursday afternoon session. And right now, at this very moment, institutional traders in these cities are executing one of the most aggressive commodity buying patterns observers have seen in 18 months. They are stockpiling crude oil futures. Not slowly, not cautiously, not through the gradual accumulation strategies that sophisticated investors typically employ. They are buying with urgency. The trading volume numbers tell a stark story. On a normal overnight session, the Asian futures markets might process 180,000 crude oil contracts between midnight and 6 a.m. New York time. This represents standard algorithmic trading, routine hedging activity, and modest speculative positioning. Tonight is different. In the first 43 minutes of the Asian Thursday session, trading volume has already exceeded 140,000 contracts. The algorithms that monitor market behavior are flashing alerts. The volume is running at nearly 4 times the normal pace. If this rate continues, tonight's session will process over 700,000 contracts before New York opens. This is not normal market behavior. The Singapore Exchange Derivatives Desk is showing heavy accumulation in March 2026 WTI crude futures. The Hong Kong Futures Exchange is reporting similar patterns in Brent crude contracts. Tokyo's commodity traders are matching these movements. Shanghai's International Energy Exchange is displaying the same buying pressure. 4 separate markets, 4 different institutional bases, 4 distinct regulatory environments, all executing the same trade at the same time. Market analysts who monitor overnight Asian session activity recognize what this pattern represents. It is called front-running. Institutional traders with access to superior information position themselves ahead of a known catalyst event. They buy before the news breaks. They accumulate before the crowd recognizes what is happening. They lock in prices before the gap occurs. The sophisticated investor understands a critical truth about global financial markets. They never truly close. When New York sleeps, Asia trades. When London breaks for tea, Singapore is in full session. When one exchange goes dark, another is just reaching peak liquidity. This creates an information asymmetry. The retail investor in Denver checks his portfolio app at 8 a.m. Mountain Time. He sees yesterday's closing prices. He believes he understands the current market state. He does not realize that while he slept, institutional traders in Hong Kong executed 200,000 crude oil contracts based on intelligence he does not possess. By the time the Denver investors market opens, the price has already moved. The opportunity has already closed. The gap has already formed. This is not a conspiracy. This is market structure. The institutional trading desks in Asia have access to resources the average investor cannot match. They employ geopolitical analysts who monitor diplomatic channels. They purchase satellite data that tracks oil tanker movements in real time. They maintain direct communication lines with energy ministers, central bank officials, and military intelligence contacts. They know things earlier. Right now, at 11:47 p.m. Eastern Time, these institutional desks are pricing something into crude oil futures. They are betting on an event. They are positioning ahead of a catalyst. The question that should concern every investor is simple. What do they know? What specific information are traders in Singapore, Hong Kong, Tokyo, and Shanghai acting upon? That has not yet reached the consciousness of Western retail investors. The answer lies in understanding what happens tomorrow morning. Not tomorrow morning in New York, tomorrow morning in Geneva, Switzerland. Because while Asian traders are stockpiling crude oil tonight, diplomats are preparing for a meeting that could determine whether global energy markets remain stable or enter a period of severe disruption. And the institutional traders are betting on disruption. The meeting is scheduled for 9 a.m. Central European Time on February 27, 2026. The location is the Palais des Nations in Geneva, Switzerland, the same building where the League of Nations once attempted to prevent World War II. The same halls where countless diplomatic failures have been documented throughout history. This is not a routine meeting. Seated across mahogany tables will be the United States Special Envoy for Iran and senior Iranian nuclear negotiators. The agenda contains one item: the framework for restoring the Joint Comprehensive Plan of Action, the nuclear agreement that collapsed in 2018 when the United States withdrew unilaterally. 8 years have passed since that withdrawal. 8 years of escalating tensions. 8 years of uranium enrichment beyond treaty limits. 8 years of proxy conflicts across the Middle East. 8 years of sanctions that have crippled Iran's economy while hardening its government's resolve. Tomorrow's negotiation represents the 14th attempt to restore diplomatic engagement since 2022. The previous 13 attempts all failed. A historian examining this pattern would note something troubling. Each failure has been followed by a period of increased military posturing. Each diplomatic collapse has triggered fresh sanctions. Each breakdown in communication has pushed both nations closer to direct confrontation. The institutional traders in Asia are not gambling on success. They are positioning for failure. But why does failure in a Geneva conference room translate into panic buying of crude oil futures 7,000 miles away? The answer requires understanding a narrow strip of water between Iran and Oman. The Strait of Hormuz measures 21 miles across at its narrowest point. A swimmer in excellent condition could theoretically cross it in 8 hours. A modern warship can traverse it in 40 minutes. Commercial oil tankers navigate through it every 90 seconds during peak traffic periods. This tiny waterway handles 21% of all petroleum transported by sea globally. Every single day, approximately 21 million barrels of crude oil pass through the Strait of Hormuz. This oil feeds refineries in India, China, Japan, and South Korea. It powers factories in Taiwan and Singapore. It heats homes in Europe and fuels vehicles across Asia. The global economy requires this strait to remain open. But the strait has a problem. Iran controls the northern coast. Iranian territorial waters cover more than half of the navigable channel. The Iranian Revolutionary Guard Corps maintains a permanent naval presence in these waters. They operate fast attack boats, coastal missile batteries, and submarine assets specifically designed for asymmetric warfare in confined spaces. On the southern coast, Oman maintains nominal sovereignty. But the United States' Fifth Fleet operates from Bahrain, just 200 miles northwest. American warships patrol these waters continuously. Carrier strike groups rotate through the region on predictable schedules. Two military forces facing each other across 21 miles of water that the global economy cannot function without. History provides clear precedent for what happens when diplomacy fails in this region. In June 2019, Iran seized a British-flagged oil tanker in the Strait of Hormuz. The incident occurred during a previous period of diplomatic tension. Within 4 hours of the seizure becoming public knowledge, crude oil futures spiked 4%. Within 24 hours, insurance rates for tankers transiting the strait had doubled. Within 1 week, alternative shipping routes around the Cape of Good Hope were being negotiated despite adding 14 days to transit times. One tanker seizure, 4% price spike, immediate global impact. Now consider what happens if tomorrow's Geneva talks collapse completely. The Iranian government returns to Tehran, having demonstrated that diplomatic engagement produces nothing. Hardliners within the Revolutionary Guard Council gain influence. The argument for maintaining restraint in the strait weakens. The political pressure to respond to 8 years of sanctions intensifies. The calculation becomes simple. If Iran cannot sell its oil due to sanctions, why should it allow competitors to ship their oil freely through Iranian territorial waters? The institutional trading algorithms in Asia are programmed to recognize this pattern. They process historical data. They calculate probabilities. They execute positions based on binary outcomes. Outcome 1. Geneva talks succeed. Sanctions ease. Tensions decrease. Crude oil prices drift lower as supply concerns diminish. The institutional traders lose their overnight positioning costs, but avoid catastrophic downside. Outcome 2. Geneva talks fail. Tensions escalate. Strait of Hormuz faces disruption threats. Crude oil prices gap upward violently. The institutional traders capture the entire move, having positioned hours before retail investors even wake up. Risk-reward analysis favors positioning for outcome 2. Because if the strait faces even the threat of disruption, the mathematics become brutal. 21 million barrels per day represents irreplaceable supply in the short term. Strategic petroleum reserves can supplement markets for 60 to 90 days maximum. Alternative shipping routes cannot scale quickly enough. Refinery configurations cannot adapt to different crude grades overnight. The price does not rise gradually, it gaps. And right now, while most investors sleep, the institutional desks in Singapore, Hong Kong, Tokyo, and Shanghai are betting that gap opens in exactly 11 hours. There's a mine in Zacatecas, Mexico. It sits 8,000 feet above sea level in the Sierra Madre Mountains. The operation employs 2,000 workers across 3 shifts. Every day, massive diesel-powered haul trucks carry ore from underground tunnels to surface processing facilities. Every hour, electrical systems consume enough power to run a small city. This mine produces silver, but it does not produce silver efficiently when crude oil prices spike. The economics of silver extraction contain a hidden vulnerability that most investors never examine, a vulnerability that institutional traders in Asia understand perfectly, a vulnerability that explains why physical silver accumulation is happening simultaneously with crude oil stockpiling tonight. Silver does not exist in pure form underground. Miners extract ore containing trace amounts of silver mixed with lead, zinc, copper, and other base metals. The ore must be crushed, processed, refined, and separated. Each step requires enormous energy inputs. The haul trucks that move ore from tunnels to processing facilities burn diesel fuel, not regular diesel, industrial-grade diesel that costs 20% more than what passenger vehicles use. A single haul truck consumes approximately 100 gallons per 12-hour shift. The Zacatecas mine operates 47 haul trucks simultaneously, 4,700 gallons of diesel, every shift, every day. The crushing equipment that pulverizes ore into powder requires electricity, generated by power plants that burn natural gas or fuel oil. The flotation cells that separate silver compounds from waste rock use chemical processes heated by petroleum-derived energy. The smelting furnaces that purify silver to investment-grade standards operate at temperatures exceeding 1,000 degrees Celsius. Energy represents approximately 38% of total silver production costs. When crude oil trades at $70 per barrel, the all-in sustaining cost to produce 1 ounce of silver averages $22. This provides comfortable profit margins when silver trades at $30 per ounce. But the relationship is not linear. When crude oil spikes to $90 per barrel, production costs do not increase by 28%. They increase by 45%. The diesel fuel costs jump immediately. The electricity costs follow within weeks as power generation contracts reset. The chemical reagent costs rise as petroleum-based inputs become more expensive. At $90 oil, silver production costs climb to $32 per ounce. Suddenly, mines operating at $22 costs with comfortable margins face a completely different reality. Projects that were profitable yesterday become marginal today. Operations that were marginal yesterday become unprofitable today. And unprofitable mines do not continue operating. The global silver supply chain depends on hundreds of these marginal operations. In Mexico, 23% of silver production comes from mines with all-in sustaining costs above $28 per ounce. In Peru, the figure reaches 31%. In China, it exceeds 40%. These are not giant operations that can absorb temporary cost increases. These are medium-sized mines operating on thin margins. They employ local workers. They service local debt. They maintain aging equipment that requires constant capital expenditure. When energy costs spike and profit margins disappear, these mines face an immediate decision: continue operating at a loss while hoping oil prices decline, or suspend operations until market conditions improve. History demonstrates what actually happens. In March 2022, when Russia invaded Ukraine and energy markets went chaotic, 17 silver mines across Mexico and Peru announced temporary suspensions within 6 weeks. The announced reason was always scheduled maintenance or equipment upgrades. The real reason was simple mathematics. Operating at a loss destroys capital faster than temporary closure. Those 17 mines represented approximately 4 million ounces of annual silver production. 4 million ounces removed from global supply within 6 weeks of energy price spikes. The traders in Asia who are accumulating physical silver tonight understand this dynamic perfectly. They are not buying silver because they believe industrial demand will surge tomorrow. They are buying silver because they understand the extraction cost curve. They recognize that if crude oil gaps upward due to Strait of Hormuz tensions, silver supply will contract automatically within 45 to 60 days. But the price will not wait 45 days to adjust. The algorithmic trading systems that dominate commodity markets are programmed with these correlations. They process the data in microseconds. Crude oil spikes, energy costs increase, silver production becomes unprofitable, supply contracts, price must rise to incentivize continued production. The algorithm executes the trade immediately. It does not wait for mines to actually suspend operations. It does not wait for supply deficit reports to be published. It does not wait for inventory drawdowns to become visible. It front-runs the entire sequence. This creates a peculiar market dynamic that confuses traditional investors. Silver prices can spike dramatically before any actual supply shortage materializes. The spike occurs Because sophisticated trading systems are pricing in the future supply response to current energy cost increases. By the time the supply shortage becomes statistically measurable, the price has already moved. The retail investor sees silver trading at $30 on Wednesday evening. He wakes Thursday morning to find it trading at $37. He cannot understand why. No major industrial demand announcement occurred. No central bank made a surprise purchase. No jewelry manufacturer placed unusual orders. What he does not see is the institutional accumulation that happened overnight. What he does not understand is the energy metals correlation that sophisticated traders exploit. What he cannot process quickly enough is that by the time he recognizes the pattern, the opportunity has already closed. Right now, at this precise moment, physical silver dealers in Singapore are reporting unusual buying pressure. The premiums above spot price for 1,000-ounce bars have increased by $2 per ounce in the last 90 minutes. This signals that sophisticated buyers are willing to pay above market rates to secure immediate physical delivery. They are not buying paper contracts that settle in cash. They are buying actual metal that requires armored transport and vault storage. This is not speculative positioning. This is strategic accumulation ahead of a supply crisis that the broader market has not yet recognized. And it is happening for one simple reason. The institutional traders in Asia know that if Geneva fails tomorrow morning, crude oil will spike. And if crude oil spikes, the mathematics of silver extraction become impossible for marginal producers. And if marginal producers suspend operations, supply contracts, and if supply contracts while demand remains constant, price must rise. The trade is not about tomorrow. The trade is about 60 days from tomorrow. But the positioning must happen tonight. The retail investor in Lahore will wake up at 7:00 a.m. Pakistan Standard Time on February 27th, 2026. He will check his phone while still in bed. He will open his brokerage app. He will see crude oil futures priced at last night's closing level. He will see silver showing yesterday's final quote. He will believe he understands the current market state. He does not, because while he was sleeping, the market moved without him. The institutional trader in Singapore started his workday at 8:00 a.m. local time. That was 5:00 a.m. in Lahore. 3 hours before the retail investor's alarm rang, the Singapore trader arrived at his desk with a briefing document prepared by his firm's geopolitical analysis team. The briefing contained information the retail investor will not see for another 12 hours. It included satellite imagery of Iranian naval movements in the Strait of Hormuz from the previous 48 hours. It contained transcripts of diplomatic communications leaked from sources inside the Geneva negotiation venue. It featured analysis from former U.S. State Department officials who maintained private consulting relationships with major financial institutions. The Singapore trader read this briefing at 8:15 a.m. his time. By 8:47 a.m., he had executed positions in crude oil futures and physical silver. By the time the retail investor in Lahore wakes up, the institutional trader has already been positioned for 2 hours. The price the retail investor sees on his phone is not the current price. It is yesterday's price. The market has already moved. The gap has already formed. This is the information asymmetry that defines modern financial markets. It is not illegal. It is not conspiracy. It is simply structural reality. Large financial institutions employ teams of analysts who do nothing except monitor geopolitical developments 24 hours per day. They pay subscriptions to intelligence services that cost more per year than most people earn in a lifetime. They maintain relationships with government officials, military contractors, energy company executives, and diplomatic personnel. They know things earlier. The retail investor relies on free news sources that report events after they have already happened. He watches financial television channels that discuss market movements from yesterday. He reads analysis written by journalists who have no direct access to decision makers. He knows things later. The time gap between institutional knowledge and retail awareness typically measures between 18 and 36 hours for major geopolitical events. Consider what happened on January 3rd, 2020. At approximately 1 a.m. Baghdad time, a U.S. drone strike killed Iranian General Qasem Soleimani near Baghdad International Airport. The strike occurred at 10 p.m. London time on January the 2nd. It happened at 5 p.m. New York time that same day. U.S. markets were closed, European markets were closed, Asian markets were open. Within 17 minutes of the strike, crude oil futures on Asian exchanges began spiking. The first wave of buying came from institutional algorithmic systems programmed to monitor geopolitical flashpoints. The second wave came from human traders who received alerts from their firm's intelligence teams. By the time New York markets opened the next morning, crude oil had already gapped up 19%. The retail investor who checked his portfolio at 9:30 a.m. Eastern Time on January 3rd saw crude oil trading at levels completely disconnected from where it closed the previous day. He could not buy at yesterday's price. That opportunity had vanished during the Asian overnight session while he slept. The institutional traders who positioned during the Asian session captured the entire move. This pattern repeats constantly. September 14th, 2019. Drone attacks on Saudi Aramco oil facilities. Asian markets opened first. Crude oil gapped up 14% before Western retail investors woke up. February 24th, 2022. Russia invaded Ukraine. Asian markets opened first. Energy and grain commodities gapped violently upward before New York opened. October 7th, 2023. Hamas attacked Israel. Asian markets opened first. Defense stocks and oil futures moved before Western retail participation began. The pattern is consistent and predictable. Geopolitical catalyst occurs. Asian institutional traders position immediately. Prices gap. Western markets open hours later at the new level. Retail investors see the move after it has already happened. The structural disadvantage is permanent. But tonight presents an unusual variation on this pattern. Tonight, the catalyst has not occurred yet. The Geneva talks are scheduled for 9 a.m. Central European time tomorrow. That is 3 p.m. Singapore time. That is 5 p.m. in Tokyo. That is 4 p.m. in Hong Kong. The Asian institutional traders are positioning before the catalyst. This is different from reacting to news. This is anticipating the news. This is betting that the talks will fail and positioning accordingly before the failure becomes public. They are front-running the event itself. The risk they are taking is clear. If the Geneva talks succeed unexpectedly, crude oil prices will decline. The institutional positions will lose money. The overnight accumulation will prove premature. But the institutional traders are making a calculated assessment. They have reviewed the history of U.S.-Iran negotiations since 2018. 13 previous attempts, 13 failures. They have analyzed the current political dynamics in Tehran and Washington. They have evaluated the domestic political pressures on both negotiating teams. They have calculated the probability of success. Their conclusion is reflected in their positioning. They are betting on failure, and they are betting with enormous size. The retail investor in Lahore has no access to this analysis. He does not employ geopolitical experts. He does not subscribe to intelligence briefings. He does not maintain relationships with diplomatic sources. He will learn about the Geneva talks outcome the same way everyone else does. He will read about it on news websites 6 to 12 hours after the institutional traders have already positioned. By then, the price will have moved. The crude oil futures he could have bought at $73 tonight will be trading at $82 tomorrow afternoon. The physical silver he could have purchased at $30 per ounce will be quoted at $36 with premiums climbing. The opportunity will have closed. This is not a prediction. This is a description of market structure. The retail investor faces a decision that the institutional trader never faces. The institutional trader acts on superior information with confidence. The retail investor must act on incomplete information with uncertainty. The institutional trader knows, the retail investor guesses. But here is the critical insight that changes everything. Sometimes the institutional positioning becomes visible before the catalyst occurs. Sometimes the accumulation patterns are so aggressive that observers can detect them in real time. Sometimes the front running becomes obvious to anyone paying attention. Tonight is one of those times. The Asian crude oil futures volume is running at 4 times normal levels. The physical silver premiums are spiking in Singapore and Hong Kong. The pattern is visible. The positioning is detectable. The retail investor who understands what he is seeing has a rare opportunity. He can position alongside the institutional traders before the catalyst occurs. He can front-run the front-runners. But the window is measured in hours, not days. By 6 a.m. Pakistan time, the Asian session will close. By 9 a.m. Central European time, the Geneva talks will conclude. By 3 p.m. Pakistan time, the outcome will be public knowledge. At that moment, the information asymmetry disappears. Everyone knows the same thing at the same time. And the price immediately adjusts to reflect that shared knowledge. The opportunity exists only in the gap between institutional positioning and public awareness. Right now, that gap is open. Tomorrow, it will be closed.